Australia has four major banks. Together, they control more than 90% of all lending in the country. Last year, they made $44.6 billion in profit. And a Royal Commission found they had been systematically deceiving their customers for years. What you're about to hear is how that became possible, and why the system that allowed it hasn't changed. This is Inside Corporate Australia, told through the stories that shaped it. In September 2008, Lehman Brothers collapsed. It was the largest corporate bankruptcy in American history, and the shockwave it sent out crossed oceans within weeks. Banks failed in the United States. Banks failed in Europe. Governments scrambled. Economies contracted. Australia's didn't. While every other major developed nation recorded at least 1/4 of negative growth, Australia kept going. GDP kept rising. By the technical definition, it was the only developed economy to avoid recession. The banks got the credit. The Big Four, Commonwealth, Westpac, ANZ, and NAB, stayed standing. No bailouts, no freeze. They kept lending. They kept operating. And international media took notice, describing Australian banking as the gold standard. A model worth studying. What those articles didn't ask was how that model had been built. The story goes back to 1983. Under the Hawke-Keating government, Australia deregulated its financial system. The dollar floated, interest controls were removed. Foreign banks entered the market for the first time. The intention was competition. What followed was consolidation. The Big Four grew. Smaller lenders struggled. And at some point, the government needed a way to manage what it had created. The answer became known as the Four Pillars policy. The rule was straightforward. No merger between any two of the four major banks would be approved. Keep them separate. Keep them distinct. There was no dedicated legislation to back it up. No Act of Parliament. The policy sat entirely at the discretion of the sitting treasurer. One person, one decision away from existing or not. Over the decades that followed, the Big Four's share of Australian lending grew from around 50% to more than 90%. They couldn't be acquired, couldn't be effectively competed against, couldn't be broken up. In 2008, that structure held, and the world called it resilience. What it actually was four institutions with guaranteed market dominance, political protection, and no real competitive pressure. And nobody was asking what they were doing with it. In 2008, the same year Australian banking was being held up as a global model, a financial planner inside Commonwealth Bank started writing things down. His name was Jeff Morris. Morris worked in CBA's financial planning division. What he was seeing was a system built on commission. Advisors pointing clients toward products, not because they were the right fit, but because the bank earned more when they did. These weren't high-risk investment plays. Many of the accounts involved were superannuation, the retirement savings every working Australian is legally required to accumulate. The banks managed large portions of it. Morris filed complaints with ASIC, the regulator responsible for financial services conduct. ASIC did almost nothing. He kept going. For 5 years, from 2008 to 2013, he built his case, spending, in his own words, a couple of thousand hours on it. ASIC later confirmed it had given him almost no support or protection during that time. In 2013, he took his evidence to ABC's Four Corners. The investigation that followed exposed what was happening inside CBA's financial planning operations. A Senate inquiry was triggered. By 2014, that inquiry was recommending a royal commission into the banking sector. The government said no. But what Four Corners had opened up wasn't limited to one bank. Across the industry, customers were being charged for advice they never received. Hundreds of thousands of accounts, year after year. Services that simply weren't delivered, including accounts belonging to people who were dead. AMP, one of Australia's largest wealth managers, had been deducting ongoing fees from the superannuation accounts of deceased clients. When ASIC began asking questions, AMP didn't stop. It misled the regulator on 20 separate occasions. Commissioner Kenneth Hayne, who would later lead the Royal Commission, had one word for this conduct. Dishonest, not careless, not the result of a system's failure. Dishonest. The money, he noted, fell into the pockets of large and sophisticated organizations. The repetition across years made incompetence an impossible explanation. Jeff Morris had first raised the alarm in 2008. It was now 2014. and the government still hadn't moved. In the year of the 2013 federal election, Australia's banks and financial institutions donated more than $730,000 to the coalition. Just over $300,000 went to Labor. The coalition won. Among its first moves was an attempt to repeal FOFA, the Future of Financial Advice laws introduced under Labor. These laws banned conflicted remuneration arrangements. They required financial advisors to put the client's interests first. They were precisely the rules that governed the conduct Jeff Morris had been reporting since 2008. The Senate blocked the repeal, November 2014, but the calls for a Royal Commission kept getting voted down. The government's position was consistent. The banks had acknowledged their problems and were addressing them. In 2016, NAB quietly announced it would stop making political donations. Nothing in government's stance changed. By 2017, pressure was coming from consumer groups, the legal profession, parts of the media, and increasingly from inside the government's own coalition. A group of Nationals crossbenchers eventually told the government plainly, support a Royal Commission or we vote with the opposition. The government's majority was at risk. On November 30th, 2017, Prime Minister Malcolm Turnbull and Treasurer Scott Morrison announced that a Royal Commission would go ahead. Turnbull said it would not be open-ended. He later admitted it would have been politically better to call it years earlier. He was right about that. The Royal Commission into Misconduct in the Banking, Superannuation and Financial Services industry opened in February 2018. Commissioner Kenneth Hayne was a former Justice of the High Court, precise, methodical, and largely unknown to the public. The government had expected the process to provide some finality, to put the controversy to rest. What Hayne did was read the documents. Over 68 days of public hearings, bank executives were required to explain on the record why their institutions had behaved as they had. The process called more than 130 witnesses. It received over 10,000 public submissions. The most significant moment came during the hearings into AMP. Counsel assisting the Commission laid out the case in the witness box. AMP had not only charged dead clients, it had actively misled ASIC about what it was doing, not once, on 20 separate occasions. An AMP executive sat in the room as this was confirmed. This was the company that had publicly lobbied against a Royal Commission, that had told regulators its problems were under control. The same pattern surfaced across every institution examined. Products steered toward the bank's own business lines. Superannuation accounts placed in underperforming funds customers couldn't easily leave. Brokers rewarded for volume. Advisors whose pay structures had nothing to do with client outcomes, not isolated failures. Systems. Hayne's final report was handed to the Governor-General on 1st February 2019. It contained 76 recommendations and referred matters to ASIC and APRA for further investigation. His explanation for why it had all happened came in a single sentence. Entities and individuals acted in the ways they did because they could. Not because no one was watching closely enough, not because the system eventually corrected itself, because the regulator had not acted, because governments had not been willing, because 4 institutions with more than 90% of the lending market had understood, correctly, that the consequences would be minimal. Jeff Morris had filed his first complaint 10 years before that sentence was written. The Commission had confirmed everything he'd documented. The Royal Commission's final report was released in early February 2019. Less than a year later, AUSTRAC filed civil proceedings against Westpac Banking Corporation. The filing alleged 23 million contraventions of Australia's anti-money laundering laws. Among them, 19.5 million international funds transfer instructions, totaling more than $11 billion, that had never been reported as required under law. Among them, transactions the regulator said were consistent with payments to individuals later identified as child sex offenders operating in Southeast Asia. Westpac had been warned that its monitoring systems were failing to detect these transactions. It had not acted. The penalty agreed between Westpac and AUSTRAC, $1.3 billion, the largest corporate fine in Australian history at that time. That figure was nearly double what Commonwealth Bank had paid 2 years earlier for its own AUSTRAC failures. 53,506 suspicious transactions that went unreported through its intelligent deposit machines, after a software error that sat unresolved for 3 years. Between them, 2 of Australia's 4 major banks had paid more than $2 billion in financial crime penalties. Within days of the AUSTRAC proceedings being filed, Westpac's chief executive Brian Hartzer resigned. Chairman Lindsay Maxted announced he would retire early. The bank issued a statement expressing regret. The government committed to implementing all 76 of Commissioner Haynes' recommendations. In the years that followed, progress was slow. Consumer advocates and independent analysts found that dozens of recommendations remained unimplemented or had been watered down. 4 were quietly abandoned. The final major legislative recommendation, the Financial Accountability Regime, didn't pass Parliament until September 2023. The Australian Banking Association, the industry lobby group that had publicly resisted a royal commission for years, issued statements welcoming the reforms. The Big Four's combined pre-tax profit in the most recent financial year, $44.6 billion, more than they had ever made. In 2023, Jeff Morris received the Medal of the Order of Australia for services to financial sector accountability. He had filed his first complaint in 2008. The 4 Pillars policy is still in place today. No dedicated legislation has ever made it law. It exists at the discretion of the sitting treasurer. 1 person, 1 decision, 4 institutions, more than 90% of all lending, tens of billions in annual profit, a royal commission that documented systematic misconduct, a financial crimes regulator that found that conduct continued after the commission closed. The policy protecting their market position has not changed. It can be removed tomorrow. That has not happened. The question this story leaves unanswered, because no one in a position to answer it has, is why someone with the power to change a system would look at everything that happened inside it and choose not to. Australia's banking system did survive the global financial crisis. That much is true. But what the gold standard label covered up was a system where the incentive to serve clients had been replaced, gradually, then completely, by the incentive to extract from them, and where the structure protecting that arrangement had been maintained, deliberately for decades. The Royal Commission didn't change that structure. The AUSTRAC penalties didn't. The resignations didn't. $44.6 billion in profit year after year hasn't. Systems like this rarely change because of a single event. They change when political will shifts, when competitive pressure builds, or when the people most exposed to them stop accepting it. None of that has arrived yet. Every company has a story, but not all of them are told. Some rise, some fall, all leave a mark on Australia's corporate landscape. This is Inside Corporate Australia, told through the stories that shaped it.